This is the India Development Debate right here on ET Now. I'm Supriya Shrinate. Right now, we're going to be assessing the state of economy and put the spotlight on the current account deficit. But at 9:30 p.m. in yet another edition of the India Development Debate, we're going to talk about green wheels. Yes, we will put the spotlight on mobility, and can electric vehicles really be a reality in our country? The government can breathe a little easy. Current account deficit showed a slight improvement in the June quarter, coming at 2.4% of the GDP. At least that's what it seems to suggest. But if you look deeper, this number is a lot higher than the previous quarter CAD numbers of 1.9%. What is also worrying is that exports have shown a growth only in the software segment. Portfolio investments have actually gone down. Forex has depleted. Is there a macroeconomic vulnerability as far as CAD is concerned, or is the picture not really as bad as many had thought it would be? Let's take this across to a special panel that's joining us right here on the India Development Debate tonight, and I'm joined by Jahangir Aziz, Head of Emerging Markets, Asia Economic Research, JP Morgan. I've got Arvind Virmani, President of Chintan Life ORG, and of course Anant Narayan, Money Market Expert. I also have my consulting editor, Maitli Bhusnurmat, with me. Thank you very, very much, each one of you, for being with us. And Jahangir, if I may open this with you, thanks for sparing time and being with us. Current account deficit increased to 2.4% of the GDP in the first quarter of fiscal year 19. Yes, it is 10 basis points lower than what it was last year at the same time, but it is a lot higher than the 1.9% in the previous quarter. How worrying is this?
Look, I mean, in normal times, I think a current account deficit of 2.5 to 3% of GDP wouldn't be something that you would, worry too much about. But the world has changed since the first quarter of this year. We have seen global financial conditions tighten significantly from April to about July, and in the month of August, it wasn't just global financial conditions tightening and investors asking questions as to how emerging markets will react. But if you look at what's happened in August, global financial conditions haven't moved very much. Instead, what we have seen is a reassessment of emerging market risk. And when we talk about emerging market risk, we obviously talk about countries that have large current account deficit, and every country, whether it's India, Indonesia, Brazil, South Africa. So even if you leave aside countries like Argentina and Turkey, countries that have had current account deficit have actually been reassessed. So in a world where emerging market risk is being reassessed, those numbers are difficult to find funding for.
Okay. Just give me a minute, because I'll take a quick word with Dr. Arvind Virmani, and then I have a follow-up with you, Jahangir, there. And Dr. Virmani, those who advocate calm on the current account deficit, those who say that there is no reason to worry, that, the current account deficit at $15.8 billion is just 5% higher than it was last year, in fact, lower as a percentage of the GDP now. While FDI flows have been strong, I mean, that's what they're pointing it out to, $9.7 billion, which is up nearly 40% over last year. Isn't that good news? Does that bring any amount of reassurance?
So basically, when the current account deficit gets to 2.5, conventionally, when I was there, we used to monitor it more closely. So certainly it needs monitoring, and I'm sure both the RBI and the Finance Ministry must be doing that. As far as the financing is concerned, certainly, whenever we have seen that whenever there is a possibility of a rate hike in the US, there is always some turmoil. As Jahangir has correctly pointed out, I think the problem is that there are a number of specific countries where there is a reason to believe that risk is high, and the ignorance about emerging markets is such, and this is not new, I have seen it decade after decade, that 90% or maybe a little less now, 75% of people who invest in emerging markets are unable to distinguish between different countries. They think of it as one category. And so this kind of thing happens. As I said, there is a reason to be careful and watch things, but I don't think there's a reason to be unduly worried.
No, that's an important point that you bring. But Jahangir, I'll take a quick question with you before I go to both Anant and Maithili. And I think we can't talk about the CAD in isolation. You've got to speak about the CAD and the rupee in the same breath. The rupee is downward spiral amidst the emerging market contagion just about continues. First we breached 70, then 71, you know, every psychological barrier, and now 72. The risk of a wider current account deficit is perhaps only likely to deepen that fall, won't it?
Look, I mean, the way in which most analysts and even government officials, etc., are discussing the current account deficit, it's all being discussed in terms of, you know, what's happening to exports, what's happening to imports, oil prices, etc. I think, you know, in a world where emerging market risk is being reassessed, that's the wrong way of looking at it. The right way of looking at the current account deficit is to say that that is the amount of investments that cannot be funded through domestic savings. Put differently, that given the amount of household savings, given the amount of corporate savings, and the government's savings that we have in the economy, the pickup in investment that has taken place from 2016 and 17 to 2018, that pickup in investment no longer is fully funded, or it increasingly has to be funded from borrowing abroad because there isn't enough domestic savings. And I think the question that financial investors and, you know, and analysts and the government should be asking as to why hasn't there been an increase in domestic savings, and the answer is probably twofold. One, that corporate savings have come down, but I think much more important has been the fact that the government hasn't, and by government again, I'm talking about both the center and the state together, haven't really consolidated their budget deficit. Their savings it has been for the last 4 or 5 years running very high, somewhere around 6.5 to 7% of GDP, and most likely in 2019 that will increase. How much we don't really know. And with that, I think the current account deficit will also widen. But I think one needs to see it not in terms of what's happening to the exchange rate, what happens to exports and imports, but rather what is happening to domestic savings and why domestic savings isn't picking up to be able to fund a larger share of India's investment.
Okay, Anand, thank you for waiting by patiently, and I think it's only fair that I ask you to follow on to that question. The point that Jahangir is making, that it's a function of, you know, fiscal space and fiscal slippage, both for the center and the state put together, and monetary policy that isn't tight enough. One expects that CAD for the second quarter is going to deteriorate further because rupee has been weaker then. But what is the broad expectation from the monetary policy on the back of these numbers?
Look, I think the background we have to start with, Supriya, is that the macros aren't looking great. To your original question, you know, the way I like to look at the overall macro is, let's look at the external sector, where I would consider the CAD and the FDI put together. Both tend to be the permanent flows coming in or out of the country. Now, that number of CAD plus FDI has been deteriorating steadily since FY17 to now. Right? FY17 actually was a surplus because our CAD was unusually low at $15 billion. In fiscal year 18, our CAD was $49 billion. Our net FDI came down to $30 billion, which means a negative $19 billion net. For this fiscal year, things are looking worse. Estimates for our CAD range from $70 to $80 billion. Let's call it $75 billion. Even if net FDI goes up to $35 billion, we are looking at a deficit of $40 billion, which is, you know, more than twice what it was the last year. Now, the nature of the problem is we are having to borrow short-term, fickle, carry-seeking money to fund this difference between CAD and FDI. Now, it isn't as if we are borrowing this money to set up industry and manufacturing and stuff like that. We are essentially borrowing this money to pay for our rising oil bills, to pay for our smartphones, and to pay for our gold. This isn't a sustainable balance. If you're borrowing money to pay for current expenses, it isn't really a sustainable balance. We have, by the way, a very similar situation developing on the fiscal front as well, where our revenue deficits are increasing, our capital spend in absolute terms has come down between FY17 and FY18 from 2.9 trillion to 2.64 trillion, which means we are increasingly borrowing and spending less on capital to fund current expenditures. Now, both these balances, fiscal as well as external balances, aren't looking great. Add to this mix the fact that our banking sector is still under doldrums. We are kicking the can down on the recapitalization, on the resolution of the loans, and the reform of the banking sector. All three put together, external imbalance, internal imbalance, and the banking sector and financial sector, tell us our macros aren't looking great, and therefore we have a problem. Now, the problem is not dire because RBI has plenty of dollars to buy us time. You know, at $400 billion, the latest number which has come out, it's still plenty of reserves. They can manage any amount of shortfall which happens, even if you see capital outflows for now. But that doesn't solve your core problems. You still have to use the time that RBI can purchase with its intervention to solve the core problems of these imbalances.
Right. No, Anand, I'll come to you in just a bit on that. But Maitri, you know, on the larger point of the rupee and the larger point of trade deficit, because trade deficit is obviously the big villain in this ballooning CAD, the actual trade deficit between fiscal year 18 and fiscal year 17 actually went up from $112 billion to $160 billion because the rupee was appreciating. You know, there were warning signs that were perhaps being missed. Deliberately to keep the rupee strong, the RBI did not intervene and allowed that rupee to strengthen. Is this scenario of our own making? Because now we are in a situation where the rupee is depreciating largely due to global factors which are beyond our realm. But the adjustment is too rapid for us now.
Well, yes, absolutely. I think, of course, though the present situation is not entirely of our making, I think we invited trouble on ourselves by allowing the rupee to appreciate and hit our export performance. The trade deficit had widened enormously between FY17 and FY18, and unfortunately, we did not act. And here I would agree with Anand to some extent. I'm less worried right now about the fiscal deficit than about the current account deficit. And unlike Jahangir and Arvind, I do view 2.5% and thereabouts of GDP for the current account deficit is very worrisome in this year, particularly for a number of reasons. First, the threat of trade wars has become much more real than it was earlier. Second, the US economy is really doing enormously well, as a result of which both the US dollar as well as interest rates in the US are going to go up very sharply. 2 more interest hikes, one in October, one in December, very much on the cards. That means not only is our trade deficit going to widen because of the trade wars, but the funding is also become questionable because of the fact that the US dollar is going to appreciate so much more and interest rates are going to go up. So both these factors make both the trade deficit wider and financing of it so much more difficult. Add to that the fact that oil is not going to come down this year. It's going to be stronger this year than in the previous year, and clearly on the external front we're in great trouble. There's just one silver lining, Supriya, very quickly if I may say so, is that the balance between fixed foreign direct investment and portfolio investment now seems to be shifting. Earlier it was always portfolio inflows that were ahead of foreign direct investment. Now this last quarter we've actually had an outflow of portfolio inflows while FDI continues to be strong. So maybe that balance is now happening because FDI is far more preferable to portfolio flows.
No, absolutely, and I want to shift focus and talk about portfolio investments in just a minute, but I want to take up a larger question with Dr. Virmani there, because the rise in CAD is largely due to higher trade deficit at $45.7 billion during Q1. The question obviously is that, you know, it also shows that exports haven't grown, and the only category for which exports have grown is actually software services, and even there just 2%. Every other export category has actually fallen. How big a concern is that? I mean, how do we alter this export scenario altogether? How do we boost it? Dr. Virmani.
Well, yeah, I want to just very briefly address the point that Jahangir raised. And you know, that is everybody, all economists, macroeconomists know there are two sides. One is the current account and the other is the saving investment balance. And I want to, Jahangir is emphasizing that the saving investment balance is now in some sense driving it. But you know, there is a bit of a confusion here. People who emphasize fiscal deficit actually are not addressing the saving investment balance, because that is more closely related to the revenue deficit. And I have repeatedly pointed this out over the last 10 years that we have to shift the government's structure from consumption to investment, because and focus on the revenue deficit, because that is roughly equal to the saving investment imbalance of the government per se. And that is very important, because if you keep focusing on the fiscal deficit, you are not going to solve this problem in the long term. Every time it comes back, the same thing happens. Okay, so leaving that aside, those who are concerned on the saving imbalance
need you to
should
quickly
focus
address
on
the export
revenue
question,
deficit
sir.
of the government. The second point on exports.
Okay.
Yeah, the export side. Now, this happens
sir.
both when oil prices go up and down. There's a lagged effect on demand for our exports. When the oil prices go down, our exports tend to go down after a lag. When oil prices go up, there is increased incomes in the oil exporting countries, and there is a positive effect on exports. So it's not that it's 100% compensated, but you will see that some of this imbalance will get corrected. But the rest of it depends on remittances. That's what I meant by monitoring. One has to monitor all those things related to the trade balance, which includes not just exports, but remittances, etc., which are associated with it.
Right. Okay. 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 Just, I'm going to move to the portfolio investment point that Maithili had pointed out there. And Anant, if I may come to you on this. Portfolio investment in Q1, like Maithili pointed out, recorded a net outflow of $8.1 billion compared with a net inflow of $12.5 billion last year, mainly due to net sales in both debt and equity markets. Is this trend here to stay? Given the fact that the US economy will grow at a faster pace, given that interest rates are going to go up there, is this a trend here to stay, where we will see the balance of power in some sense shift from portfolio investments to FDI?
Yes, Supriya, there's a good chance that the trend continues in this particular fashion. Even if it recovers, it will probably be neutral rather than seeing large inflows. Now, we have to remember the last year, a bulk of in fact, almost the entire portfolio flows were debt portfolio flows. For the last few years, what we've been seeing is, because we've had a stable currency and because our real interest rates in India have been kept high by this inflation targeting framework that we have, we've attracted a lot of carry trades into the country. One of those big components was FPI in debt. We've also had others, net exporters selling, NRE deposits coming in, ECBs coming in unhedged, and other speculative positions. Now, we've had all of those flows coming in, adding to the RBI's coffers, making good the deficit we had on current account deficit, and they're still leading up to appreciation of the rupee. Now, therefore, we have this overhang of unhedged carry positions sitting with us, and then to expect more to come in at a time when global monetary policy is actually tightening and liquidity is tightening is a little difficult. The challenge we have right now is to ensure that the existing portfolio investments and the carry investments don't all flow out together. Let's remember, even after this big moves that we've seen, we still have $60 billion of FPI in debt remaining within the country, and they've been surprisingly resilient so far. Now, the task that we have, including using monetary policy, is to ensure they don't all flow out at the same time and exacerbate the issue that we have on the currency front. To answer your question, portfolio flows will be tough to come by at a time when global liquidity is reducing, and the attractiveness of the Indian investments that we had, both with real interest rates and a stable currency, is now diminishing.
Right. Okay, Maithili, very quickly, I think Soumyakanti Ghosh's note of yesterday says that if rupee averages 73 to a dollar this year and crude, I think, stays at about or averages about $76 to a barrel for the remaining half of this year, our import bill is likely to rise by about 45,700 crore rupees, if I remember that figure correctly. How worrying a prospect that really is, because many people believe that is going to eventually, eat into your fiscal space.
Well, Supriya, when the rupee depreciates, your other imports, they might react. You might see some contraction in demand for other imports. But as far as oil import is concerned, we really have very little choice. It is completely inelastic almost to whatever the price is. So it will be a very worrisome thing, particularly if oil prices continue to be high. And as we are seeing with Trump tightening the screws, as it were, on Iran, and things becoming increasingly difficult to look for alternate sources, we're trying to look for loopholes in those sanctions that the US has imposed, but it's going to be very difficult. So yes, it will be very problematic problematic, particularly if the rupee continues to weaken, because as Jahangir and Arvind also said, very often emerging markets are seen as one class. We're nowhere near Turkey, we're nowhere near Argentina, we're far, far better. But very often when people get frightened, when investors take fright, they all look at emerging markets as a class. And that could certainly be very, very worrisome for us.
All right, fair point indeed, but I'll give a quick last word to Jahangir, who's on the phone line with us. And Jahangir, very quickly, I'm running out of time here on the show. The data does show, and it's important that I point this out, that there has been a depletion of $11.3 billion in Forex reserves in this Q1 versus an accretion of $11.4 billion last year. Is that disturbing? Because many people believe that as this contagion spreads, RBI will need so much more money to throw in to somehow defend the currency.
Look, I mean, if you want to worry about it, you can worry about it. But think about why we accumulated the reserves over 2016 and 17. We accumulated the reserves for a rainy day. That's the reason why you want to accumulate reserves. You don't want to accumulate reserves just for the heck of it. You're doing it because you think that at some point in time, you have a bout of volatility, and in that bout of volatility, you will need this reserves to be used in the opposite direction. And I think it's the right thing to do, to smoothen out volatility. And that's basically what the reserves were meant to be used for. That's what the reserves are being used for. So I'm not really perturbed by the fact that India is losing reserves or the RBI is defending the currency, because the RBI isn't defending any level of the exchange rate. If the RBI was using that reserves to defend a level of the exchange rate, then you needed to be worried, and you need to be really worried. But as far as I can make out, the RBI isn't using to defend any level of the currency. It is letting the currency adjust to the market pressures. It is using it to basically smooth out volatility, and that's exactly why the reserves were accumulated in the first place. So, I mean, I find it very, very ironical that people get concerned about reserves being used up, because that's exactly what they were meant for.
Okay. On that note, thank you very, very much, Dr. Arvind Vermani, Jahangir Aziz, Anant Narayan, and of course, Maithili Busnurmat for joining us. Current account deficit is a fault line. We've got to ensure it does not deepen. We've got to ensure it doesn't feed into the fiscal space as well. And on that note, we'll keep an eye on the state of the economy right here on ET Now. We take a really quick breather and we come back with yet another edition of the India Development Debate tonight, which is on mobility. Green wheels. Can India realistically turn all its cars and all its vehicles into electric vehicles by 2030? We come back and analyze and debate all of that in a moment from now.